Today, got a real treat for you. Two trades and exactly how they work and how they're set up. And each one of them made over 4 times the risk that you take with your stop. And this is a methodology that is rooted in price action and bar structure, completely repeatable, completely applicable to every market. Every liquid market. So just to show you that these are things that can be found ahead of time, I posted actual footage from a private chat that I'm in with some friends, and you can see at 9:03 a.m. on the S&P. Here's probably some irrelevant / inappropriate comments here, but 42.93 versus 42.81 is the ES 5-minute risk bar. It's actually this red one here, and we'll zoom in on it when we go into the chart and I show you exactly how to find that, but you can tell we haven't even broken past it yet at the time of this screenshot. And then I'd mentioned that 43.40 is 4R. 4R means the point at which you would make 4 times your risk. Similarly, at 8:53, which was 10 minutes before this, and the reason I put this one first is because it played out first. Crude had been a little more annoying and irritating, but it did finally play out and do exactly what it was supposed to. Sorry, I shouldn't phrase it that way. A market is never supposed to do anything, but it did finally play out and do what I expected it to. So at 8:53, and again, this is a 5-minute chart, while that red bar was forming, I was mentioning that this can now be the risk bar for a bigger move down in CL, and it's basically what I called a 5-minute ABC up after the daily low violation, and this is the exact same thing in the opposite direction. It's a 5-minute ABC down after a high violation, and I even drew in what the move to 90.13 would look like from up there to down here. 90.13 would be 4R. And the stop level above here, just coincidentally, which ties into the work we did with U-turns yesterday, the stop level here would also be a good stop and reverse level because it is a U-turn. So hopefully this gets you excited to listen to the detail that's upcoming. But basically here are 2 trades in one day where we made 4 times our risk in a very methodical, repeatable way. So here is the daily chart of the S&P 500, and the first thing that gets you even looking for this trade is taking out the previous day's high. So from February 16th, we've had a lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. When you break above this, that string, that down string, is changing now. Because we know for a fact as soon as it pierces that even by 1 tick, we now have a higher high. Doesn't mean it can't go outside and do that. You know, outside bars will always stop out this particular system. But once that gets taken out, we know to now look for the lower time frame entry. So let me put in previous high of day. So we broke the previous high of day at 6:50 in the morning, and we went up all the way to this level here at 7:35 in the morning, and there was a GDP news at 7:30. So this little move here was a little climax on the GDP. I'm sorry, it wasn't GDP news. It was Michigan sentiment, and there was something else, PCE, but there was some economic news right there. So as soon as we make this high, I start looking for the 2 waves down on the 5-minute. Now, because this high happened so close to the pit open, I use a 5-minute chart. Had we gotten this low violation during the Asia session, I'd probably use a 30-minute chart. You know, had we got it during the European session, I'd probably use a 15 or a 30. But because the violation only happened, a couple hours before the open, I figured a 5-minute chart would be sufficient. So coming from here, we're doing the same thing that we do with all of our bar counting. If it has a lower low and a lower high, it's a down bar. All of these have that. And then outside bars take the label of the previous bar. This has a lower low, lower high. Inside bars take the label of the previous bar. So we very methodically have one downswing. Now here is a higher high. Inside bar takes the label of the previous bar. Outside bar takes the label of the previous bar. Higher high, higher low. Now lower high, lower low. Inside bar, inside bar. So again, now this is the this is a hoagie right here. We have this bar here. So to me, nothing that happens inside that hoagie is significant. The next time we take out either the high or low of this bar is where I would draw in my next bar. And here it's a lower low, lower high, lower low, lower high. So this here was our upswing. This here was our downswing. Now this is exactly what we're looking for, an A, B, C down on a 5-minute chart after we've had the daily high violation, because now we know the daily direction is up. So the whole goal of this is to catch daily upside potential with a very limited 5-minute risk potential. So this right here is our risk bar. And if we go back to this PowerPoint, I don't know if I can make that any bigger, but see if you can recognize it's the exact same point that I had pointed out here at 9:03 a.m. And let's see, the time of this bar, the time of this bar is 9. So 9 to 9:05 is when this bar was formed, and the 9:05 to 9:10 bar broke that. So the high here is 42.93. So 42.93 and a quarter would be your buy stop over here, and your stop would be one tick below this. The low is 42.81 and a quarter, so your low would be 42.81. So 12.25. Okay, I probably estimated it at 12 when I did this in my head, but times 4 is 49 points. 49 points on top of 42.93 would be 43.42. So we got to 43.42 by this bar right here. 43.42 by the 9:55 bar. So you basically took this much risk, 12 points, 12 and a quarter points, and made 49 points in about an hour. And it's still going. If you look at it all the way to the high of day now, which is 43.76, minus 42.93 is 83 points divided by 12.25. We're at 6.7 times your risk all the way up to here. So because this was such a ripe daily change of pattern, I would typically leave some to run for 8x, which could take more than just today to accomplish. But also, as jittery as things are with the war and whatnot, 4 are, nothing wrong with that. Rinse and repeat. In fact, that's what we'll do now. Let's go and look at the second example where we did this exact same thing. And that second example is right here. So at 8:53 a.m., we were looking at the ABC up on Crude after the daily low violation. So let's get back to that. And change this chart to Crude and start with the daily. So the daily chart, this was a down bar, but then this was the first up bar. This was inside, which makes it an up bar. This is also an up bar yesterday, which left a huge tail. So as soon as that bottom gets taken out, I was looking for a pattern that, a short-term pattern against that daily trend to enter. So let's put in this, which draws us this red horizontal line at the previous day's low. And here is our 5-minute chart. So we got our low violation right here at 8:05 a.m. Sorry, at 8:05 a.m., which was right after the pit open. The pit open is 8 to 8:05. On this bar, which was 8:05 to 8:10, we got that low violation. So from that point, we have an up bar, an up bar. This is inside, well, this is all a hoagie right here. Let's see, is this part of the hoagie? 9201, 92, this is also part of the hoagie. And then we got the down bar. And then an up bar, and an up bar, and an up bar. This becomes the risk bar right here. So this whole move is up. This one bar is your down, and this was 91.42 at the bottom. This is 91.40 at the bottom, so it is still a higher low. And we got this right there. So that is our ABC pattern up on the 5-minute after we got the daily low violation on crude. And using the high and low of this bar, and let's just go back to the PowerPoint for a second, where you can see if you can recognize that's the up, down, up, and this is our risk bar that I'm calling out right here before it breaks. That was at 8:53 a.m. And this bar is 8:50 to 8:55. The 8:55 to 9 o'clock bar is what broke down here. So if we take this risk as a sell stop at 92.40 with a stop at 92.99, that is a 49-cent stop, times $4 is $1.96. $1.96 from 92.40 minus $1.96 would take us to, that doesn't sound right, 92.99 minus 92.40 is 59 cents of risk times 4 is $2.36. 92.41 minus 236 is 90.05. Oop, looks like we got to exactly 90.06. So I don't typically include that extra penny of stop and that extra penny of entry in my R calculations. And I do that because I'm thinking of this as an algorithm would, just on a bar by bar count. So doing it that way, we came 8 cents away from the 1 cent stop and the 1 cent entry, which is 2 cents times 4, 8 cents. That's how I got to 90.13 as my target, and that which I'd posted in the chat. So from there, two things of note. One is, bam, we got to 90.06, low of day. So call it a penny shy of that 90.05, and there's still an hour and a half of pit session left. But another interesting thing to note is we got this bar here at 9:20. And let me clean this up here. One of the things I mentioned yesterday in the U-turn trade is if the entry bar is a bit heavy, you can always look to enter halfway up the bar. So halfway up this bar of 92.41 plus 92.98 divided by 2 is 92.69 and a half, and we got right up to 92.69. So, almost half, missed it by half a cent. So there's two ways you can enter this, right? One is to use that as your risk bar, set your stop, set your target, go play golf. Or you could let it trigger, wait for the pullback to that 50% level, and be watching it to get right in there, in which case you're really making 8R instead of 4R because your risk is only half the risk that you would have taken over here. So that's something to consider, perhaps a small entry initially just in case it runs away, and another entry when you go back into your risk bar. And again, the reason why you don't do that every time is in our S&P example, once this bar triggered, at 42.93 and a quarter, the lowest it ever went was 42.93 and a half. So you never even got in there. So that's that's an argument for at least putting some of your position on the risk bar. And with the crude example, again, there's no shame with just taking the risk bar and making 4 times your risk over the course of the day. But if you are super nimble, you could also look to add here and get a trade that would be 8 times your risk. So anyway, this is actually worth its weight in gold, but I'm not really a YouTuber. Just need an outlet to share, and I probably get like 6 views despite all the gold that's in here. But if you have any questions about this methodology, you want to chat, drop a like, subscribe, ask me questions. I'm happy to engage on my favorite topic in the world.